We are doing a sum of Feb March 2022, paper 32. It is of cash flow. Our first question is, what is meant by the term cash equivalent? So, cash equivalents are short term, highly liquid investments, short term, highly liquid investments that can be readily converted to cash and which are subject to less risk, very less risk, or insignificant risk of changes in value. Now we read the next part of it. We have been given the statement of financial position for 2020 and 2021, and you are asked to prepare a statement of cash flow. Whenever you're asked to prepare a statement of cash flow, the statement starts with profit before interest and tax. So your first target would always be to find out the profit before interest and tax. You're given two non-current assets. For the two non-current assets, you have to prepare two accounts. That is the asset account at cost and the provision for depreciation account. Other than that, if we read, there is a fall in the value of your current assets, so it will be subtracted. Fall in the value of trade receivables, so even this will be deducted. Opening cash and cash equivalent, this comes at the end. You have your equity and liability section. If you see over here, your ordinary share capital has increased from 400 to 600. This means that there is an issue of shares. It means that there is an issue of shares from 400 to 600. That means 200 shares are issued. Issue of shares is a financing activity. Then over here, if you see, your share premium has increased from 70 to 120. There is an increase of 50. So it means that you have issued your shares at premium. It is a financing activity. Money is coming in. There is revaluation reserve. Right now, I don't know what is it for. Retained earnings. Retained earnings section always helps us to find the profit for the year. And from the profit from the year, you would reach at PBIT, profit before interest and tax. Apart from that, if you see, your non-current liability is reducing. That means you have repaid your debentures. So even this is a financing activity, it will be a minus. Current liability is reducing. It comes in operating activities. Bank overdraft at the end, this will come at the end of your cash flow statement. And then you have your total liabilities and total equity and liability. So what we will do is we will start with the first part of our cash flow statement, wherein we have to find out the profit before interest and tax. Your profit before interest and tax minus interest minus tax gives you profit for the year. And this profit for the year you will get from your retained earnings. So you have your retained earnings column, which you already know. Retained earnings at the start is increased by profit for the year. From that, you will minus your dividend paid. You will minus your transfer to general reserves. Here, I did not see anything, so this is not there. And you get your retained earnings at the end. So let's start filling this. Your retained earnings at the start is 109. Profit for the year, I do not know. Minus dividend paid. If you see over here, you have an interim dividend that is paid and you have a final dividend that is paid. Final dividend is always for the last year An interim dividend is always for the current year. That means your final dividend would be paid for the last year, so it will be paid on 400,000 shares. An interim dividend is paid for the current year, so it will be paid on 600,000 shares. You multiply 400,000 shares into 0.20, and you multiply 600,000 shares into 0.10. So you will get your dividend paid as 80,000 is your final dividend and 60,000 is your interim dividend. 80,000 and 60,000. So you have totally paid the dividend of 140,000. So you have paid the dividend of how much? 140,000. You will use this dividend paid in your sum. So let's see what is your dividend paid. So your dividend paid comes up to 80 plus 60, 140,000. So when you're making your thing, so dividend paid is 140,000. You have your retained earnings at the end as 136,000. You want to find your profit for the year. So you will go in the reverse direction. 136 plus 140 minus 109. So your profit for the year comes up to 167. And this profit for the year you will put over here. There is no tax information given, but they have told you that 44,000 interest has been paid. So your interest is 44,000 that you have paid. So you will arrive at profit before interest and tax. From down, if you're going on top, you're going to add. So 167 plus 44, you are going to get 211,000 as profit for before interest and tax. So 211,000 will be your profit before interest and tax, which you will find out from your working note number 1, which you have done. You can pause, do the working yourself, and then you will go ahead. So your profit from operations is 211,000. In this, you add your non-cash, non-operating expenses. Non-cash, non-operating expenses. So you will get your profit before working capital changes. Your profit before working capital changes. Before I go to this non-cash, non-operating expenses, I will see what are my working capital changes. There is an increase in inventory and there is an increase in trade receivables. Increase in inventory is deducted. Increase in trade receivables is also deducted. And you have your trade payables, which is falling. Current liabilities is your trade payables. Decrease in your trade payables. Decrease in your trade payables is subtracted. So this is your working capital changes. Now what you are left is with the adjustments for your assets. With relation to assets, you will always prepare a working note and you will see what is the information that is given to you. I have land and building. Cost is being given and depreciation has been given. And an adjustment related to land and building is given over here. So let's see. Your land and building on 31st December 2020. That means at the beginning of the year. Okay. What is your land and building at the beginning of the year? It is 650,000. This is 650,000. It comprised of land, which was 250,000, and building that was 400,000. And this building has been revalued to 330,000. So your building value totally becomes how much? Sorry, this land has been revalued to 330,000. So on 2020, your land has been revalued to 330,000 and your building is 400,000. So your total value on 2020 of the revalued land and the old building becomes 730,000. And in 2021, the cost of your land and building is showing 1,150,000. So on 2020, your land and building after evaluation is considered is 730,000 and in 2021 this is 1150,000. It means there is an increase in your land and building, and this increase is because of purchase of land and building. Purchase of land and building is an investing activity. It would be subtracted. So your purchase of land and building is an investing activity. So you see cash flow from investing activities. You have your purchase of land and building. How much? We already calculated. It is 420,000. It is an outflow. So it will be subtracted. Purchase of land and building. Now I will go to the depreciation related to land and building. The depreciation at the start is 160,000. Depreciation at the end is 201,000. There is no other adjustments. I will close the account 201, 201. So I will get this 41,000, which is my depreciation on land and building. It is a non-cash expense. So it is added to profit before interest and tax. So from your profit from operation, profit before interest and tax, you are going to add back the depreciation on building, 41,000. Now I will proceed to the next one, that is plant and machinery. With this, I have completed my land and building adjustment. Land and building section is already completed, and adjustment related to land and building is over. Now I go to my plant and machinery. Plant and machinery was sold. Whenever there is sales of an asset, the selling price would be an investing activity because you have received money from sale of a non-current asset. So this 3,000 that you have received, selling price is your selling price is investing activity. Investing activity, you are going to add it. And the profit on the sale of your non-current asset, your plant and machinery, it is non-cash, non-operating income. So it will be deducted. Let's see the effect of this. Profit on disposal of your plant and machinery. The profit 2,000. Okay, it is non-operating income. So it will be subtracted, and your sale of plant and machinery, that is your selling price, is investing activity. You have received the money from the sale of investment which was in plant and machinery. This will be added back. Now I move ahead to the plant and machinery. I have opening balance of 454 at the start, closing balance of 539 at the end. I have sold the plant and machinery. I have sold a plant and machinery costing 12,000. It is disposal 12,000. Now when I close this account, if it does not tally and I get the balancing figure on the debit side, there is purchase of plant and machinery, which will become my investing activity. So 539 plus 12. This is 551. 551 minus 454. I will get 97. And 97 is purchase of plant and machinery. It is an investing activity. It would be subtracted. Purchase of plant and equipment, investing activity, it is subtracted. Now I will go to the provision for depreciation account on the plant and machinery. During the year, an item of plant and machinery that was costing 12,000 was sold for 3,000 at a profit of 2,000. That means the net book value of the plant and machinery was 5,000, selling price plus profit. So my accumulated depreciation on the plant and machinery is 7,000, which I have disposed of. I have plant and machinery at the start as 274, plant and machinery at the end as 326. I have disposed the plant and machinery worth 7. So I have the depreciation on plant and machinery 326 plus 7. So this is 333. 333. From this 333, I would deduct the 274. I will get the depreciation of the plant and machinery 59. This depreciation is non-cash expense. It will be added back. So depreciation of plant and machinery 59,000 is going to be added back. The plant and machinery costing 12,000 was sold at 3,000, and this 3,000 includes the profit of 2,000. That means the net book value of the plant and machinery is 1,000. I have sold an asset of 1,000 at 3,000. That means I had a profit of 2,000. So selling price minus the profit is going to give me the net book value. So the accumulated depreciation on the plant and machinery is 11,000. So 326 plus 11, this is 337. 337. 337 minus 337 minus 274. 337 minus 274. I have the depreciation of the current year as 63. This is non-cash expense. It will be added back. So the depreciation of plant and machinery is 63,000. Now, whenever you do a sum of cash flow, you will put the headings at first only. That means operating activities, cash flow from investing activities, cash flow from financing activities, and as and when you do the adjustments, you will keep on writing whatever you find out. Okay. After you do these adjustments, we'll take one by one our different things. Assets is already done. Our assets is already done. Increase or decrease in the current assets is done. We also wrote our cash flow from investing activities, the share capital that was there, investing financing activities. In financing activities, we had our proceeds from the issue of share that we calculated 200 over here and 50 over here. It is an increase. So proceeds from issue of share is 250,000. You have repaid your loan. How much? 50. Even this was financing activity, repayment of debentures, and your dividend that you have paid. You calculated on top how much dividend have you paid. You have paid a total of 140,000 of dividend. Money is going out. This is financing activity. After that, you will check if there is anything left. This is your cash balance at the end. This adjustment was done, dividend paid is done, issue of shares is done. Again, the interim dividend is done and plant and machinery is done, interest paid. Now you start operating activities. This is after the working capital changes, you will get cash generated from operations. Cash generated from operations minus interest paid, you get your net cash flow from operating activities. You've done your cash flow from investing activities. After doing the minus and add, you will get 514. There is a negative cash from investing activities. So you will write net cash used in investing activities. Then you see your cash flow from financing activities. There was issue of shares, repayment of loan, debentures, and dividend paid. So you get net cash from financing activities. After you add cash flow from operating activities, cash used in investing, and cash from financing activities, you get a net decrease in cash and cash equivalent. You will add your cash and cash equivalent at the beginning. So you will get your cash and cash equivalent at the end, which you see is a negative figure. That means it was a bank overdraft. You will check over here. If this is the same, that means your sum is correct. So this is how you prepare your cash flow statements. You can pause the video, do step by step, and again go back if you're getting stuck. Let's go to the next part of it. Explain two reasons why a business prepares a statement of cash flow in addition to the income statement and statement of financial position. We prepare a statement of cash flow because it will give us an additional information about from where we are generating the cash and where we are using the cash. So 1 and 2. It is the statement of cash flow is produced on a cash basis, whereas your income statement and statement of financial positions are produced on accrual basis. That means it also takes the outstanding and prepaids into consideration. So why we prepare a cash flow? Because it is on cash basis. We get additional information from which activity we are generating cash and from which activity we are using the cash. Let's go to the next question. In the year 31st December 2021, all the interest due 44,000 has been paid. During a directors meeting, the finance director had been asked why he has raised the bank overdraft to finance the acquisition of non-current assets. Now let's see at our answer. You have purchased non-current asset. You have purchased building. You have purchased plant and equipment, which is a very big figure. So you have invested a lot of amount, which is leading for your cash flow to become negative. And this has resulted in a bank overdraft of 242. So the finance director was asked that why has he raised this bank overdraft to purchase the non-current assets? To finance the acquisition of non-current asset, justify your answer. If you buy non-current assets by raising a short-term finance, what is good in it? Bank overdraft is a short-term loan. So you need very strong cash from operations in the coming year if you have to repay this. Time to obtain overdraft is shorter. That is the reason, that could be a reason why he has raised overdraft. Or there is very minimal cost and it has no impact on the gearing ratio. If he takes more debentures, it will have more loan funds as compared to own funds. The point against him taking a bank overdraft and buying too much of investment is that long-term assets should normally be financed by long-term financing. Interest rate on the overdraft may be higher than the debentures. So it will lead to a lot of interest payment. and also overdraft is repayable on demand. So advise the directors whether he was correct in raising bank overdraft. We could say that he was correct in raising the bank overdraft because it was easy. His cash generated from operations is very good. What is his cash generated from operations is 175. So he has the ability to repay and it is no impact on the gearing ratio. So maybe he was correct in raising a bank overdraft as he thinks that he is able to repay it quicker. However, he should not forget the fact that long term assets should always be financed by long term financing, and he should also consider the interest rates on the overdraft as compared to the interest rate on the as compared to the interest rate on the bank loan and over debentures. So this is it. You have to pause the video and keep on seeing.